All right. Today we have Kit Bennett. He's the new director of development for Inland Development Partners. Kit has been doing development work around the Twin Cities for years, most recently working for the Opus Group and the Excelsior Group. Hey, Kit, thanks for being here.
Howdy, good to be here. Thanks for having me.
Yeah, of course. First, tell me a bit how you got into this new role. You've just been there for a couple months now, right?
Yep, it was, I think the day was September 26th, so a little over a month now, month and a half or so. And kind of happened little organically. Tom Shaver, who's one of the partners over here, had a relationship with him for through NIOP actually, doing their mentorship program through their developing leaders program. And so met with him, 5 years ago or so. And actually, Tom has a history of working at Opus handful of years ago. And so when I moved from Excelsior Group to Opus, Tom kind of helped me kind of find that path and figure it out and make that decision to go learn a ton there. Opus is a phenomenal company and kind of fully vertigrated system with architects and engineers, contractors, project managers, and the development team as well. So that was a really great experience. Learned a ton, get to see a ton of projects, both organically and kind of inbound with the size of the platform they have. And then most recently, a little bit before my start date, just with meeting with Tom, getting monthly coffees for the last 4 or 5 years or so through that mentorship relationship, we kind of kept that going. I know a lot of those mentor-mentee relationships don't always last too long, so I was just lucky to get linked up with a guy like Tom and continue it for a while, and kind of floated the idea of joining the team over here. And initially, wasn't thinking that would be the case, and kind of as we talked, decided to make the move to a little bit of a smaller group. So that's a bit how it happened, and we'll see where it goes. So happy to be here and kind of see where it takes us.
Yeah, awesome. That sounds great. Can you tell me a bit about what your experience has been, what your work was and what it's going to be here?
Yeah. It'll be fairly similar in relation to my role at Opus and here, kind of digging up and leading industrial development efforts, both speculative, build to suit, and then what's a little bit different here would be acquisitions versus Opus, which is a true ground up developer. And then I guess how that differs from previous roles where I was at Excelsior Group and before that Dominium, doing affordable housing at Dominium and a bit of market rate at Excelsior Group. So bit of a pivot from asset classes, and with affordable housing, you're dealing with tax credits and local and federal governments. So a lot more cooks in the kitchen, you'd say. And so, but moving from here, similar to the role at Opus, but with the smaller group, kind of more on all of our shoulders to kind of be hungry and kind of keep finding deals, making relationships, and kind of almost having that strategy kind of morph as the market moves on you as well. So industrial is the focus, I'd say, and then how we operate in that system will probably change, year to year, every so often, to kind of respond to those market changes too. So
Sure. Sure. I want to ask you a bit about what you're seeing in industrial, but first, how did you first get into this industry?
yeah, I kind of randomly, I was going to the U of M, graduated in 2014. Didn't really have any idea what I was going to go try and do. There when there's job fairs and folks coming in, they're kind of all pushing, Target and Best Buy and kind of some of those big established Fortune 500 companies that are in the Twin Cities. I wasn't, sure if that was for me or kind of how I wanted to do it. And so ended up connecting during my senior year of college with a few guys who were in the real estate industry, primarily brokers, who'd either lived by me, who were within my age range, who'd been working for a couple of years. And throughout my senior year, that kind of spread out to getting a coffee or two a week over the course of fall to spring semesters, and liked what they had to say. Loved the how real estate's tangible. You have an idea and then you go, it either gets built or rehabbed or whatever it is, and kind of breathes new life into certain communities or just a building that's been kind of long and forgotten, maybe within St. Paul or Minneapolis. So I always like that piece of it. And so met with a ton of brokers, and then that kind of spurred into meeting general contractors as well as developers. And then got linked up with a developer at Dominium, and January of 2015, joined their internship program they have, and then stayed there for 3 years, which was kind of oddly enough bit lucky to fall into, because there's not too many places that hire development jobs right out of school. So that was a really good place to, as the proverbial saying goes, drink through a fire hose and just kind of learn it all, because didn't study real estate in college, but kind of felt like that was a bit of a post-grad school effort of just learning it all and getting to see a ton of deals. So kind of fell into it that way, and then it spread from there.
Yeah, I hear that a lot. People just kind of end up in the industry almost, and they
Yep.
find they like it. Can I ask what you did study in college?
Yeah, finance and marketing.
Sure.
So development was a bit of a combination of those two in a way.
Right.
Early on, liked the analytical piece of it and kind of financial modeling and stuff like that, which gives you just a basis of how these projects work on the numbers side.
What do you like about this work?
It's a good question. One of the biggest things for me is just the people, honestly, in the industry and within the companies I've been at, and both clients or folks that you just work with and meet. It's Minneapolis is a small, close-knit community, and then real estate's almost an even smaller, more close-knit community within that. And so you're always kind of bumping elbows with everybody, and you meet a bunch of people, and everyone's just really nice, fun to work with. And so that's one main thing that I've always enjoyed from the get-go. And I'd say next is really just the variety of kind of day-to-day work and project to project. Every project's different. Even with industrial, they're all just loaves of bread sitting on a site plan when you're looking at it that way. But there's unique challenges with the city or utility connection, zoning issues, whatever it is. And so even if the product might be similar a little bit from one project to the next, the circumstances and problem solving from one to the other is quite different. So keeps you on your toes, and you're constantly learning, and that's always fun and does not get monotonous, for sure.
Definitely. I wanted to ask you a bit about that. So you've done that work with multifamily and affordable housing and things like that. How do you approach the job differently when it comes to industrial?
That's a good question. It's interesting with industrial, especially when I'm comparing it against affordable housing. With affordable housing, that need is so great for that product type, and it's hard to get done. Where if it was easy to do, a lot more companies would be doing it. But lining up all of these local and federal incentives is it's taxing to do that and set up your project for success. And so you have to be really specialized in that. And so when you're working on those types of projects, it's really knowing the details and kind of absolutely everything about how do you even get the project from A to B. Where then you look at industrial, it takes a lot of those complications, I'd say, with kind of getting your capital stack together, with the tax credits of the equity buyer, who's going to buy those credits. And that kind of takes that piece out of the picture. And then kind of, especially with speculative development, the issue is understanding the market, what are tenants doing, what submarkets and areas have certain construction going on, who's your competition. And so a little bit more tactical on the market analysis and research side of it, and understanding that to make sure you're not putting yourself at too great an exposure of risk. Where with the affordable housing, if you could get it done, you knew it was going to lease up, because we're far behind in the needs for that. And so you're not really looking at, well, are we going to be able to lease it up? You're typically going to be able to do that no problem. Where with speculative industrial, it's a bit of the opposite. It's who are the users, what size they're building, who is our competition, and that's a bit different. So it's fun to think about it in that way.
Sure. But we have been in kind of a peak time for industrial, right? I mean, what are you seeing happen with that market right now?
Another great question. It's at this juncture, it's really hard to say. 6 months, 8 months ago, was maybe the end of kind of what I'd call just the most recent hot streak of industrial being kind of the darling of all real estate classes, where you saw interest rates going to almost to zero, and then cap rates on the exits that we could underwrite to were starting to shrink. So when I started looking at industrial projects, the kind of yield that developers build to, it's the spread over kind of what your exit cap rate's going to be to make sure the project's financially viable. And that started when I looked at it at maybe you built it to about a 7. Cap rate exits in industrial were around a 6. Playing for 100, maybe 150 basis point spread, and that those cap rates went all the way from 6 to some trades in the high 3s last year in 21. And then once this kind of inflationary and interest rate increases that we're seeing from the Fed, the reaction to that is immediately just increasing cap rates, and the buyers who are putting debt on these start getting a little bit backwards on their modeling when their interest rates are going above their cap rates, and they're getting what's called negative leverage there. And so, not to go too much in the weeds on that, but that sort of started shifting in the spring, where a lot of these trades that were happening either were getting retraded to higher cap rates, or some buyers were just fully exiting the market. And kind of right now, what we're seeing is the debt markets are frozen. So even if you had a piece of land or an acquisition to close on today, you wouldn't be able to get the debt to finance it unless you're an all cash buyer. And so that, coupled with construction cost increases on inflation, and the interest rates, and kind of land is still at a premium, I'd say, with land sellers still, looking back at 2020, 2021, and expecting those prices with shorter due diligence periods, and that expectation should and will need to change a bit, where projects are just getting hard to pencil. And kind of put a finer point on the end of that is just there aren't really trades happening right now, so it's hard to know what kind of spread or yield or exit to build to on these projects. So a lot of folks are kind of wait and see until January 1, when kind of that fiscal year ends and there's more capital that needs to go out just on a yearly basis. So it'll be interesting to see what happens. But at this juncture, a lot of folks are kind of sitting and waiting to understand how things are going to unfold. So it's what we do know is that it's going to be different in 2 months. It's going to be different in a year. It's going to be different in 2 years. And it's just kind of staying on top of that and watching it unfold, and staying active, but don't get underwater or anything too quick, just since we don't know how it's going to play out yet.
Yeah, I've been keeping an eye on reports and waiting for the kind of fork in the road. I've been feeling like that's been coming up, and it's still, what you're telling me is like, well, we're still kind of waiting to see.
Yeah.
So you're saying it's really cash buyers who are, is there a worry about kind of national investors that have maybe a lot more cash on hand, potentially having large control of the market here in the future?
That's a good question. There's kind of two, and then now a third kind of large consolidation of industrial square footage as owners throughout the market, and it's Link Capital Partners, and now Nuveen has a decent share as well. And so with them, unless their strategies change and they start selling, unlikely somebody is going to come in and take a big position, especially just with the volatility. And it's hard for folks, even a cash buyer, to make sense. And when they're doing that, they don't want to overpay on things, because they gotta be really precise in their underwriting. So I don't know if that's necessarily a worry, but consolidation of ownership with those three groups has certainly helped the market, where all these things are working against us, but when those groups consolidate their portfolios, it's helped rental rates kind of increase to offset some of those challenges. It's not a perfect science, but when all those things are working against you, you need something to offset it if projects are going to be able to happen. And so, that consolidation of ownership, if anything, has helped. And the Twin Cities has historically lagged behind other markets in that rent growth. And so we feel like we're now kind of catching up to rent growth that was maybe missed in previous years, just from how the ownership is spread throughout the industrial kind of pipeline here.
Yeah. And that consolidation of ownership isn't necessarily unique to industrial either.
Yep. Right.
So, without giving away any trade secrets or whatever, where does that kind of leave you guys? How are you guys looking toward the future right now?
Yeah. Right now we're cautiously optimistic, I'd say, about the market and where it's going. and really it's just being a bit more tactical where, a year ago, maybe you'd buy, the math was, not easy to make sense of, but the tenant demand, it's still there, and it's been really strong for the last, 12 quarters or so. And it's still, pre-COVID, the amount of active users out there was, maybe 7, 8, 9 million. Kind of a year ago, it was upwards of 14 or 15, and now it's closer to 11 or 12 million, which is still, 3 million or so higher than, pre-COVID levels. And so with the kind of constriction of supply and some of these, sites that are on pause, whether that's, equity partners backing out, or, unable to get debt, or a land seller that's impatient and, isn't going to give you an extension on time, the kind of forecasted supply, is going to just be going down, and we don't really know to what magnitude yet. And so with that, that's only going to, one, should, positively impact, the rates that groups are quoting, both on, renewals and new construction. And then, just a little bit less on the competition side. So, it doesn't mean, go snatch everything up that you can, but, trying to find land positions for when the market, settles a bit, and maybe spec works, once the dust settles, or maybe then if you can tie up some land, build to suit, where it's kind of the opposite of speculative, where you have either a land identified, or you have a client you're working with and going to find land for them. That'll likely, pop up a bit more. And so it's kind of just, finding ways to be strategic and active, while there's this kind of waiting period, as opposed to hitting the brakes and, waiting to see, but also still trying to make some things happen while you're waiting. Otherwise you'll be too late by the time things change.
Sure. Are there any submarkets you're most optimistic about right now?
Yeah, I mean, typically, especially recently, the Northwest and the Southwest have always performed the strongest, and have done really well. The Northwest, there's more land, in this third quarter. So the highest absorption Twin Cities ever seen occurred this last quarter, Q3 of 22. And the Northwest is interesting because, so I believe it's about, 38 to 40% of all activity in the third quarter, occurred in the Northwest submarket, and that market has 20 to 22% of all the inventory, of industrial classes. So, just seeing the amount of requirements and users that are looking in that area, is certainly optimistic. Now there's a lot of projects going on. There's 1 million square feet going up there with the Cubes project. And so there's land there and people are active, but the demand is there. And so that's certainly optimistic. And then, the Southwest has always been strong as well. It's pretty built out. So you got to kind of go to farther reaches of, whether it's Shakopee, Prior Lake, Chaska, certain areas that, have a little bit of land that you can do. And so that one is, tougher to find land sites, but, feel pretty good about that market as well.
Yeah. Cool. Kit, I don't think I have any other questions. Is there anything you want to add that I didn't ask about?
I don't think so. But I really appreciate the time and having me on. It's been, good to chat with you.
Yeah.
And I'm sure we'll talk
You too.
again soon.
Yeah. Awesome. Well, thank you so much, and congrats on the new job.
Appreciate it. Thanks, JD.